Another day, another story. In the dynamic world of business, borrowing plays a significant role in meeting financial needs and fueling growth. Whether it's securing capital for expansion, investing in new projects, or managing cash flow, businesses often turn to borrowing as a strategic tool. We will explain the needs of businesses for borrowing and explore various means along with examples of borrowing strategies. Needs for borrowing. 1. Capital investment. One of the primary reasons businesses borrow is to finance capital investments. These investments include acquiring new equipment, expanding facilities, developing new product lines, or investing in research and development. Borrowing allows businesses to access the necessary funds up front to make these crucial investments, helping them remain competitive and drive growth. Example: a manufacturing company may need to borrow funds to purchase technologically advanced machinery that enhances productivity and increases efficiency, ultimately leading to higher output and profitability. 1. Working capital. Businesses often require additional working capital to manage day-to-day operations, pay suppliers, cover payroll, and handle unexpected expenses. Borrowing can provide the necessary liquidity to bridge temporary cash flow gaps and ensure smooth operations. Example: a retail business may require a short-term loan to manage seasonal fluctuations in sales, allowing them to stock inventory for peak periods and meet customer demand. 1. Business expansion. As businesses aim to expand their operations, they may need funds to enter new markets, open additional locations, or acquire other businesses. Borrowing can provide the necessary financial resources to execute expansion plans and capture new opportunities. Example: a restaurant chain planning to enter a new city may seek external funding to open several new locations simultaneously, ensuring a strong market presence and accelerating growth. 1. Debt restructuring. Sometimes, businesses borrow to restructure their existing debt obligations. This may involve refinancing high-interest debt, consolidating multiple loans into a single loan, or extending the repayment period to ease financial burdens. Example: a company burdened with multiple high-interest loans may opt to borrow a larger loan at a lower interest rate to pay off existing debts, thereby reducing overall interest expenses and improving cash flow. Means of borrowing. 1. Bank loans. Traditional bank loans remain a popular means of borrowing for businesses. Banks offer various loan products tailored to meet specific needs, such as term loans, lines of credit, and equipment financing. These loans typically require collateral, a solid credit history, and a comprehensive business plan. Example: a technology startup seeking funds to develop a new software application may approach a bank for a term loan, presenting their business plan, financial projections, and potential return on investment. 1. Trade credit. Trade credit allows businesses to buy goods or services from suppliers on credit terms. This form of borrowing is common in business-to-business transactions, enabling the purchasing company to delay payment for a specified period, typically 30 to 90 days. Example: a retail store may negotiate trade credit terms with its suppliers, allowing them to stock inventory without immediate payment. The store can sell the products and generate revenue before the payment is due, effectively using the supplier's credit as a short-term borrowing strategy. 1. Venture capital and angel investors. Startups and high-growth businesses often seek funding from venture capital firms and angel investors. These investors provide capital in exchange for an equity stake in the company, supporting its growth and expansion plans. Example: a technology startup with a groundbreaking product idea may secure funding from a venture capital firm that believes in its potential. The startup receives the necessary capital to develop the product and expand its market reach. 1. Crowdfunding. Crowdfunding platforms allow businesses to raise funds from a large number of individuals who believe in their vision or product. This method of borrowing is particularly useful for small businesses and startups without access to traditional financing options. Entrepreneurs can present their business idea or project on crowdfunding platforms, set a funding goal, and offer rewards or equity in return for contributions. Example: A socially conscious startup aiming to produce eco-friendly and sustainable products may launch a crowdfunding campaign to raise funds for manufacturing and marketing. Supporters who resonate with the company's mission can contribute funds in exchange for early access to the products or other exclusive perks. Borrowing is a crucial financial strategy for businesses seeking to meet various needs and drive growth. Whether it's obtaining capital for investments, managing working capital, expanding operations, or restructuring debt, businesses have different needs that can be fulfilled through borrowing. The means of borrowing are diverse and can include traditional bank loans, trade credit, venture capital, and crowdfunding. Each method offers unique advantages and considerations, depending on the business's circumstances and goals. Understanding the needs and means of borrowing empowers businesses to make informed financial decisions. By carefully evaluating their specific requirements and exploring the available options, businesses can select the borrowing strategies that align with their objectives and financial capabilities. Proper planning, realistic projections, and effective utilization of borrowed funds are essential for successful implementation and repayment of borrowed capital. With the right borrowing strategy in place, businesses can unlock opportunities, sustain growth, and navigate financial challenges effectively. Thanks for watching.